undergraduate trades. So when we're looking at the undergraduate trades we could have had this morning, and the ones that you could have had simply by taking the undergrad fixed trade ideas, you can see that you could have taken a 13R response. If R is 1%, then of course that means you've had a 13% day. If R is 2%, then of course that means you could have had a 26% day. Not a bad morning. 26% return on your account with a 2R maximum, 2R risk. So when we think about R being 2%, that would mean that you have a 4% risk, remember. If you're using R as 1%, then a 13% day is still incredibly profitable. Now, the good thing about that 13% return is obviously on the back of yesterday's very, very good day. You would have obviously made a lot more yesterday during the drive, of course. But regardless of that, this is still a systematic response to trading, isn't it? This is still a systematic return. This is not a speculative return, if you like, in terms of, you know, a lot of things that you have to decide to do. This is the undergraduate return you would have made. And the difference between the undergraduate return and the professional return on occasions could be quite dramatically different. Yeah. So you might be saying, okay, so what was the first sell trade? What do you think the first sell trade was? Take a look at the time of the day and take a look at what the trade was. What was the first sell trade from a systematic point of view? We covered this in yesterday's classroom. What was the first sell trade from a systematic point of view? It's not obviously an RGL trade, because obviously how can that be an RGL trade when it's going to be at a high price? So it cannot be an RGL trade. So what trade did we cover yesterday as the first systematic trade of the day? Let me guess, nobody was paying any attention to yesterday's classroom. Surely somebody was paying attention to yesterday's classroom. It was the gap close trade. Do I see thousands of people typing in the gap close trade? I see thousands of people typing in the gap close trade. Did anybody remember I talked about the gap close trade? Obviously not. So this was the gap close. So based on the gap close trade, yes, thank you, Kim. Obviously, people don't pay any attention to any of the classes I do anyway, so it's all right. I'm used to that by now. So this was the gap close. And obviously, this is a very, very straightforward trade. Obviously, the gap is back towards the bottom edge. And obviously, the trade is based on the candle close from 8 o'clock onwards. From 8 o'clock onwards, that was the rule. And it's the first candle close in the direction of the gap fill. Is that the first candle close in the direction of the gap fill from 8 o'clock? Is that the systematic rule? So obviously, based on that, we've got the stop at the prior high. We've now got our entry price. We now have a target price of 3R plus a 1R target price to get 4R total. Okay, so the idea is this is now our target, correct? So we take the short sell. We're now in the deal. We're now looking to make some monies. And obviously, we start aiming for some target prices. We had a beautiful 2R return there. You had another opportunity to go back in again at this stage if you wanted to build around a position. And obviously, you've got this idea that if that's 1R, that's 2R, that's 3R target price right there. Does everybody agree that you've just hit 4R? So that's your 4R target price right there. It's not 4R on one contract, it's 4R total, a 1R plus a 3R trade. 1R plus 3R. Because remember, after the 1R trade, you might well have been putting your stops at break even, which may have stopped you out at break even there, which is why I was talking about the re-entry price if you still like the short. But then that would be up to the pros to make a decision on that. If you're an intern and you got stopped out there for break even on your entry, that's it. That's the trade finished at 1 hour. Okay, so you still made 1 hour. You still made 1 hour. You just never got the extension to the 4-hour target price. The gap close trade. Now, obviously, that's the gap close. We don't need to know about RGLs. Of course, a gap close trade will nearly always be against the RGL trade. And that's the problem, isn't it? It's nearly always against the RGL trade. It would be very difficult to be, and obviously you might be saying, but in what circumstance could it ever not be against the RGL? Well, because of course, we may well be trading in opposite directions from the London Open versus the US close. There may well be a difference between those prices. But let's now take a look at now that that trade is finished, we've closed the gap. We can now look at the idea of closing the gap. Now, where are we going to close the gap to? Well, interestingly enough, the RGL price. I mean, the RGL is going to be where the gap is, correct? Does everybody agree with that? Is that really obvious? Of course, it's really bloody obvious. So we know we're going to be closing the gap to the RGL from yesterday. So if you go through your tweets about where the S&P RGL was, what price was the S&P RGL, guys? What price was the RGL? Look at your tweets. The RGL was 82.84. Yeah? So the RGL is 82.84. So obviously this has got to be a sell trade if it's above 82.84, right? It's got to be a sell trade. And where does the target price stop? 84. Is that not incredible? I can see it obviously gets everybody riveted in the fact that that is indeed the RGL price, which also corresponded to the 3-hour target price. You couldn't make it up, could you? Couldn't get any better, Stuart. So we make 4R our money. We're already sitting on a 4% return if we're using a 1% per hour trade narrative. We've already got 4% return on our account in the first trade. So now we're on to the idea that we are probably going to be bullish today because we're green RGL, correct? Unless we go through 82s at the bottom edge, we're probably still going to be holding on to that green RGL. Now, obviously, this is still the cash open of the London session. So we now put our RGL trade on the books. This is the London session now that's currently developing, but it's still above the US RGL. There's the US RGL narrative there, right? There it is. So this is still blue against the US RGL. So I still want to be buying this. What's the rules? What's the rules? Does anybody remember the rules? I'm guessing not, since nobody knew what the sell trade was. I'm guessing that the goldfish syndrome set in again for everybody. But let's imagine that the goldfish syndrome wasn't setting in and people actually learned something from yesterday's classroom session instead of randomly forgetting everything. The rules are very straightforward. I'm not going to embarrass anybody by asking. The rules are that when the market is in a green zone, or when the market has a bullish RGL, that's not a green zone, when the market has a bullish RGL storyline, that when we get a dark, I'm going to change the color of the box. Okay, we'll click on that. When we get a dark blue candle, we get a buy limit order 1 tick below it. When we've got a buy candle of 1 tick below it, the prior fractal is our 1 hour target price. If that's our 1 hour target price, we then have the ability to do a stop, a hard stop. And that means it's the distance between the 1 hour target price and the entry buy limit order price is the 1 hour stop, which gives us a 2 hour risk if we're doing 2 contracts. There's your 2 hour risk. And now we've got the ability to develop the trade. We have a possible target price, and this is where we can go variable on this because obviously we now have a target price of 1 hour. We've got a target price if we have the value, for example, diverging strongly, we would then introduce to the undergrads the ability to take a 2-hour profit, or if the value is still very bullish, a 3-hour profit. So we have a 1-hour target, we have a 2-hour where a decision is made, and we have a 3-hour target. Now, obviously, when we see this storyline, we can obviously understand this storyline now, is that once we achieve a 1-hour target price, the stops move to break even +1 here. Okay, stops move to break even +1. And we're now ready to start trading these ideas. We also have the ability that if the candles are green and we like the value, again, this is more of an undergraduate developing into the postgraduate course. This is like a year 4 entry, as of course we can go with the momentum of the flow, which is taking the reversal of the blue candle as well, assuming the value or the order flow lines up with that trade. It can still be an undergraduate trade. It's simply a blue candle reversal, assuming that the blue candle is still below the halfway stage, going into the halfway stage of the prior bracket. In other words, here is where the other entry price here for the momentum trade is, assuming that you are happy with the value that's available. So you can take that trade as well as this trade, or you can take that trade exclusively against this trade if the value is kicking off big style. So let's take a look at that trade there. We can see the blue candle, yes. We're all happy with the blue candle. Now, obviously, when that blue candle closes, we now have the ability. We are still above the RGL. Here's the RGL here. We're still above the RGL, so we're only buying. Remember, the reason why this has gone red is because we've gone through this at the present moment on the right-hand edge, which colors this red. This was not colored red at the time, of course, because it was only just starting to form. So we're in a blue market. The blue candle comes in. The blue candle comes in, which is a sell and a buy market. And therefore, we put a buy limit order below that blue candle 1 tick. There's your buy limit order, yes or no? If that's your buy limit order, we now have a 1-hour target price of this price here. We now have a hard stop at this price here. There's your hard stop right there. So we now have our 1-hour target price. We now have the story to deal with. Now, because of the time of the day, I think we're going to get a volatility expansion. It's early enough in the day to start thinking about volatility expansion. And this is why there is an aggressive buy trade here, because it's still at 9 o'clock in the morning. We haven't had a volatility expansion yet. In other words, we haven't broken out of the RGL yet. So I still think we've got the break of either the buy or the sell RGL to come. And obviously, in basis of what we're seeing here, I think it's going to be a break of the buy side. So we're going to break up through the buy side narrative here. So obviously, we've got the buy trade here. We've got the aggressive momentum trade here. And the momentum trade has the same concept. The difference with the momentum trade is the hard stop is 1 tick below that price, correct? 1 tick below the prior low. That gives us a 1-hour, 2-hour, 3-hour storyline. So there's 1 hour to that price there. See it? There's the line. So there's your 1-hour price. And obviously, you're going to have your 2-hour price as well, which you can see, obviously. So there's your 1-hour price. There's your 2-hour price right there. And there's your 3-hour price. Do you see it? Your 3-hour price right there. So you've now got your 3-hour price. Now, obviously, you've now got a good idea about the structure to this trade. You've got a buy trade here with a limit. You've got a buy trade here with a momentum. You're trading in the direction of the RGL is still positive, bearing in mind this buy trade was at 85.25, which is what? Above the RGL 82.84 level, correct? It's above the RGL level, so it's a buy trade. It's got to be a buy trade, hasn't it? So we're going long. And only long. So we get the buy trade on, we hit target 1, we hit target 2, we hit the 3-hour target for the volatility extension here. In other words, we make 4R on the momentum trade. And you can see, interestingly enough, that the 4-hour target on the momentum trade is almost the identical price to the 3-hour target on the fade trade. You see that? It's almost the identical price. In other words, we've got a lot of algorithms that will use that exit price as a walkaway trade. Does everybody see that confluence of exits? It's quite an important element, isn't it? Because these are simple calculations. These ideas of measures we know are commercial through and through. These ideas of the algorithms having the same target price regardless of which entry you are taking gives us this confluence price area that simply doesn't exist anywhere else. So in other words, we've picked up 4R on the structural gap fill, and we've picked up 7R on these two buy trades here. This is at 11R, potentially 11% return on our account, 11% return on an R of just 1%. So now we've got another blue candle. We can see that the close of the blue candle, or sorry, the low of the blue candle is still well above the RGL, so I still want to buy this. The stop that's connected to that is taking us down to this price here, so we're a little bit towards that 84, but we're still above the 84, still above the 84. So there's a buy limit. We've got a 1R target, a 2R target, and a 3R target here. We've got all the targets lined up. So obviously what happens? We get the buy trade on, we don't get stopped out, we stay long, the price breaks out of here, and obviously at this stage, you can see quite clearly that it's now 12 o'clock lunchtime. I don't think at 12 o'clock lunchtime that we are going to extend the volatility anymore. We tell everybody in the class that comes in late into the London session that there's no point in starting to get involved in volatility extension trades here because of the time of the day. So in other words, the undergraduates get to know these things and they start developing a pro mindset, don't they? A pro mindset that starts to allow them to take those other clues that we teach, to not expect to see the 2R, 3R target prices. And therefore, obviously, when we hit the 1R target price as an undergraduate, your stops are now at break even +1. So you bank your first profit and your second contract scratches out when we trade +1. Happy? Well, the interesting thing is we get another narrative, another blue candle on the stop candle here. And that gives us another buy opportunity, one tick below. And obviously the hard stop is pretty much still in the same place. It moves up a little bit. Doesn't make any difference because we achieved the 1R target again a second time. Now, the reason why we don't take this trade here is because obviously that would be doubling our exposure to the same trade. You know, we can only take one trade at a time. So unless it's a momentum buy trade, which we added to here because the momentum we're buying with a winner, we don't add to a losing trade. Do you understand? We don't add to a losing trade. This is adding to a winning trade here. This would be adding to a losing trade, and we don't want to do that as an undergraduate. That's a commercial accumulation. You haven't yet reached the stage of understanding commercial accumulations. So what our target price is here, and it's realistic to think that that might be the target price because of the time of day. Yeah? Because of the time of day, you can obviously start recognizing that that's probably going to be it. 1300 hours, the US guys are coming to desk. We know that the volume is going to start increasing. The 1300 hour candle is one of the most important candles in the bond market. So we know that this candle here is going to direct traffic even on equities. We're going to start seeing the bonds starting to cause more action taking place here. So a good opportunity to bag your money and just walk away. So even if you didn't, you still scratch out at +1. And you can see that we went immediately into red. We never transferred through the blue zones here. We immediately went into red, telling us that we were now moving into a sell trend. We never transitioned from the buys to the sells. We immediately moved into a sell trend because of what was happening in the auction process here. It didn't transition from a buy to a neutral. It transitioned from a buy to a sell. This transition from a buy to the neutral into a fade. This transition from a buy into a neutral into a fade. This transition from a buy into a neutral into a fade. This transition from a buy into a sell. Big difference in transition, isn't it? And it's visible from that single screen. So all of a sudden, when it transitions here, we can see that this is now transitioning into a short sell. And as it transitions into a short sell, we can also recognize that that's probably now going to take the London session offered. There's a London session red mid price. You can see it does take the London session offered now. And this is now expected. If that's painted blue, you could have argued for the short sell coming back in, couldn't you? For the volatility to now expand on the sell side of the book. But that's the end of the trade based on these systematic interns or undergraduate trades. Can everybody agree that that's exactly, having said that this is exactly what we taught yesterday, I would be surprised if everybody does, but can everybody at least humor me with an agreement that that's exactly what we taught you yesterday? Humor me with a nod. And therefore, you could have made 13% based on a 1 hour percent basis. 1 hour percent basis. So as an undergraduate, an incredibly successful morning, wasn't it? As an undergraduate, an incredibly successful morning. And that's all it takes. Now, what about the postgrad? As we start to recognize the story that's associated with the undergraduate trades, let's see if the postgrad had any different opinions about any of these deals. Let's take a look at the real economy. Did the postgrad have any difference of opinion about any of these trades? Did the postgrad have any input into possible additional trades that we could have taken? We can see that the bottom line here is a buying opportunity for sure. The top edge here is quite clearly a sell divergence creeping in. Can we agree that the exit price certainly isn't a sell trade? Can we agree that this buy, we would probably be wanting that extra extension to buy into, wouldn't we? We'd probably want to squeeze the price a little bit lower into that box to get away from this balance developing here, that's for sure. So in other words, we wouldn't have been really under pressure on the press as a post-grad buyer or a professional buyer. So I think as a professional, you would still be aware of the structure is still above the RGL, but you'd probably be buying down here more realistically. When we come back up to the top edge here, I don't think there's anybody that thinks you should only book your 1 hour profit. I think everybody would be looking at that as a probable fade reversal sell. So there would be a fairly reasonable conversation to be had that this is a short sell opportunity. We would be fairly reasonable that this would be a probable short sell opportunity as well. So whilst you may have taken these, which I don't think you would have, I don't think would have been even attempting this buy in the first place. But the professional trader is now selling these. But do you see how the storyline remains the same? Do you see how the storyline remains the same in terms of where the levels are, where the keys are, where the narrative is? And as we come into today's cash open, you can see the idea is that we want to be buying the cash open. And obviously, we've already seen the cash open kicking off there, and it's gone very bullish indeed behind that bottom edge here. The professional trade. Interestingly, coming into what price? the overnight session low RGL. Interestingly, coming into what price? The wholesale price level of 45.80. Interestingly enough, we've now got a lot of things that we would be wanting to use as a pro trader to make a decision at. We know that the wholesale price levels are going to be decision prices. We know that the session swing highs and lows are going to be decision prices. And therefore, as a professional, can we all agree that there would have been a higher probability that as a professional, you would be buying the cash open today rather than selling it as a professional? Well, you're not going to be selling it, that's for sure. You might sell it at higher prices, but you're not going to be selling it here. Never in a million years would you be selling it here if the value is going back up again. So we can obviously understand this as a process. We can understand the idea behind each of these as intern trades and pro trades. And that's what we're looking for, isn't it? That's the storyline we're looking for. But that's obviously this morning's trade session. That's the interns undergraduates trade. And that's what you should be trying to think about, where you are in your trading journey, about trying to figure out whether you want these as buy trades or sell trades. And that's it. That's us up to date.